was deemed as history's most spectacular failure.
Former Archegos capital management owner Bill Wang has been arrested this morning by federal agents.
Imagine spending the last 2 decades of your life building up a net worth of almost $30 billion, just to lose it all in the span of 48 hours and in the worst way possible. Unfortunately, this was the painstaking reality of Bill Hwang. I mean, over the years, countless of corporations have lost billions of dollars in a small time frame. But what makes Bill's situation so unique is the fact that only one man caused so much mayhem that it reverberated throughout the entire financial world. It's the perfect tale where a man tiptoed on the fine line between success and catastrophic failure. Born in South Korea, Bill Hwang had a religious upbringing, with his father being a pastor and mother being a missionary. He arrived in the United States not being able to speak a single word of English, only learning it whilst he worked night shifts at McDonald's. But unfortunately, Bill's father died just soon after, with his mother having to relocate to Los Angeles. After his father's death, Bill went on to earn an MBA from a university in Pittsburgh after studying economics at the University of California. Although it looked like Bill Hwang's destiny was set for him to just live as another worker, his life took a complete turn in the early 1990s. Although some would say it was for the better, it was this moment that initiated the rise and fall of Bill Hwang's fraudulent $20 billion empire. After completing his education, Bill joined Hyundai Securities as a salesman in the early 1990s, and he excelled at his job, so much so that he caught the attention of Julian Robertson, the man who ran one of the most successful hedge funds at the time and was renowned for his investing, with anyone that worked with him or under him having huge financial success in their own hedge funds. And so Julian Robertson took Bill under his wing and taught him everything he knew. Julian Robertson ran a hedge fund called Tiger Management, and it's this company that gave birth to Tiger Asia. In 2001, Julian staked Bill with an estimated $1.2 billion to start Tiger Asia, which was a hedge fund that focused primarily on Asian equities, and the entire purpose was to profit from market inefficiencies and price movements in the Asian markets. And Bill ran the company well and was great at his job, with Julian naming him as the Michael Jordan of Asian investing. But this title would soon come to meet its end. During his years at Tiger Asia, he used an incredibly aggressive investing style with 3 specific methods. Rather than diversifying his assets across a broad range of investments, Bill's approach was to concentrate Tiger Asia's portfolio on just a few stocks. And although this amplified how much money the funds made, this method was very susceptible to market movements, which could lead to significant losses. Secondly, Tiger Asia was known for targeting stocks that were heavily shorted by other companies, aka short sellers. Short selling being when a trader borrows shares from a broker and immediately sells them with the expectation that the share price will fall shortly after. If it does, the trader can then buy the share back at a lower cost and return them to the broker and keep the difference that he made. By focusing on short sellers, Bill aimed to capitalize on the potential of a sharp rise in the stock's price, which would force short sellers to buy shares to cover up their losses, further driving up the prices of his stocks. And lastly was Bill's aggressive use of leverage, which involved borrowing funds to amplify the size of an investment. And once again, this certainly amplifies profits, but it significantly increases the risk of debt, and it meant that even small price movements could lead to significant losses. And unfortunately for Bill, the effects of his dodgy methods were creeping up to bite him back. It all began in 2008. Despite managing Asian funds, he faced significant losses from a short position in the German Volkswagen market. At the time, Porsche aimed to acquire Volkswagen, and by 2008 controlled 43% of the company. This was a big problem for short sellers like Bill, who needed to borrow shares for shorting, as Porsche had significantly reduced the available shares, and the result was a massive short squeeze, causing Volkswagen shares to quadruple in just 2 days, with Volkswagen becoming the most valuable company in the world at $370 billion before crashing down. But this absolutely crushed his short position and made investors in Tiger Asia furious that the MJ of investing was just out losing bets in Europe. But the final nail in the coffin happened in 2010, where Bill Hwang was investigated for a Chinese insider trading scheme, and 2 years later in 2012 he paid $44 million to settle the case, and in turn came the end of Tiger Asia. But this is where the story begins. After the disaster in 2012, Bill started up a family office called Archegos Capital. Archegos started with a measly $200 million, but expanded at a ridiculous rate, and this was all because of TRS, total return swap. The process involved Bill paying a fee to a bank to let him bet on the direction of a stock. Bill would then use money that he borrowed from these banks to buy a ridiculous amount of shares, and as Archegos kept anonymously buying more stocks, the price of these stocks would then go up, giving Archegos market-to-market profit, because the shares Archegos bought earlier at lower prices were intentionally worth more now, and to ensure they didn't lose a significant amount, the banks would then hedge their positions and buy the underlying stock that Bill owned. Bill rinsed and repeat this method, doing it at a larger scale every time he was successful, and gaining the trusts of bigger and bigger banks. And as Archegos grew larger, banks were happy to take fees from such a big company, but unbeknownst to them, they created a financial bomb and were buying stocks that he artificially drove up with their own money. But for the time being, the scheme absolutely worked. It was brilliant, with the SEC stating that as a result of Huang's trading, Archegos allegedly underwent a period of rapid growth, increasing in value from 1.5 billion in March 2020 to more than 36 billion in March 2021. However, there was one thing that could not happen at all costs, which was to let the banks know what he was doing. Everything was going fine until ViacomCBS triggered Archegos' collapse. On March 22nd, 2021, Viacom announced a $3 billion secondary share sale. This led to a 20% sell-off in stock and significantly dragged down the value of Archegos' portfolio. In an attempt to stop the deteriorating market by himself, Bill mounted a massive offense to boost Viacom by himself, but it just didn't work, and Viacom kept falling. It even got to the point that banks met and discovered the scale of Archegos' scheme and the scam that they'd been running for all these years. Prosecutors stated that over the next 2 days, Bill and his team scrambled to stall the banks from calling in their margin loans, but on March 26, 2022, Bill ran out of time. The banks abandoned their trades by selling off large sections of Archegos-linked companies, which totaled up to $30 billion in total, which led to Bill personally losing $20 billion in just 2 days. And on that same day the banks pulled out, Archegos was completely shut down. Bill Huang was then arrested and charged with fraud, and so came the end of the man that gained fortune so quick but lost it even quicker.